A 28-year-old quantitative analyst sits at his desk in the JPMorgan London office on a Tuesday morning in early 2012. He opens a spreadsheet, not a sophisticated trading algorithm, just a basic Excel file, and begins copying data from one column into a new value-at-risk model. His fingers move across the keyboard with the muscle memory of routine. He types a formula. He divides by the sum instead of the average. The mathematical error is elementary, the kind that would fail a first-year statistics exam. No one reviews his work. No one catches it. Within hours, the spreadsheet distributes across the chief investment office, and a risk calculation that should have screamed "danger" instead whispers "manageable." This single keystroke error, a misplaced denominator in an equation, will eventually hide $6.2 billion in losses from public view for 3 months. It will launch a crisis that rocks the global financial system and forces the King of Wall Street to admit, under testimony, that his bank was sloppy and stupid. This is the story of the London whale, and it begins not with recklessness, but with arithmetic. JPMorgan Chase in 2012 was untouchable. The bank had survived the 2008 financial collapse while competitors crashed and burned. While Lehman Brothers evaporated and AIG needed a government bailout, JPMorgan had actually acquired failing institutions and emerged stronger. The bank had $2.3 trillion in assets. It was the largest bank in the United States. Its CEO, Jamie Dimon, was not just a banker, he was a titan. He had a reputation as a brilliant strategist who had steered the ship through the worst financial storm in a century. On Wall Street, his word was currency. When he spoke, markets moved. When he predicted stability, investors believed him. The bank's chief investment office, the division at the center of this story, was supposed to be the ultimate expression of this competence. It was the safety department. It was the fortress. It was the hedge against catastrophe. Its entire purpose was to protect JPMorgan's deposits from sudden market shocks. Instead, over the course of 3 months in early 2012, it became a machine for hiding losses and gambling with the bank's survival. The division was run by a woman named Ina Drew. She had worked at JPMorgan for nearly 2 decades. She was respected, even revered, within the industry. Drew oversaw a team of traders and analysts tucked away in a corner of the London office, physically separated from the main trading floor. They called themselves the cavemen because they operated in isolation, insulated from the scrutiny that governed the rest of the bank. The separation was supposedly a feature, not a bug. The chief investment office wasn't supposed to be a trading desk. It wasn't supposed to be generating profits. It was supposed to be managing the bank's cash reserves and hedging against systemic risk. Hedging means protection. It means buying insurance. It means reducing exposure. Except somewhere in the winter of 2011 and early 2012, hedging became something else entirely. It became a way to gamble with other people's money while calling it prudence. In January 2012, the Office of Controller of the Currency issued a memo. JPMorgan's balance sheet was bloated with what regulators called risk-weighted assets, essentially assets that required the bank to hold more cash in reserve. The more risk, the more cash you had to keep on hand. It was a capital requirement designed to ensure banks could survive a crisis without government bailouts. JPMorgan was told to reduce its risk-weighted assets. It was a direct order from regulators. Instead of shrinking its risky positions, instead of selling its exposure and moving to safer ground, the Chief Investment Office made a calculation. What if they could offset the risk by taking an opposite position? They would buy insurance against defaults on corporate debt. They would sell credit default swaps, essentially betting that large American companies wouldn't go bankrupt. The more swaps they sold, the more income they generated, and that income could be used to cover costs and reduce the reported risk on the balance sheet. It was elegant. It was legal. It was also catastrophically reckless. The trader executing this strategy was a French national named Bruno Iksil. Iksil was not a screaming cowboy. He was methodical, quiet, almost academic in his approach to trading. He commuted from Paris to London weekly, spending his weekends with his family and his weekdays managing positions worth tens of billions of dollars. He was good at what he did, maybe too good. Because as the weeks passed in early 2012, Iksil began to realize what he was building. The position was becoming enormous. The exposure was becoming dangerous. He started sending emails to his management chain flagging the danger. "It's getting scary," he wrote in one message. He suggested they reduce the position. He suggested they hedge their hedge. His bosses told him to hold the line. They told him the regulators wanted this. They told him this was strategic. He was a loyal employee. He followed orders. He bought more swaps. He sold more insurance. He dug deeper. The hedge Iksil was buying was tied to the CDX.NA.IG.9 index, a basket of credit default swaps on 125 large American companies. It was one of the most liquid derivatives markets in the world, meaning it should have been easy to buy and sell. Except Iksil wasn't making small strategic trades. He was accumulating a position so vast that he was literally the only buyer in certain segments of the market. By early April 2012, his team had amassed a $157 billion notional exposure, notional meaning the total face value of the bet. To understand the scale, that was roughly equivalent to the entire market capitalization of Boeing. He was a single trader, sitting in a London office, controlling a derivative position larger than one of America's most valuable companies. And he was buying in a market where there was no one else willing to buy at his prices. He was propping up the market with his own money, like a man inflating a balloon larger and larger, hoping no one noticed how thin the rubber had become. By early April, the market started to notice. On April 6, 2012, Bloomberg News published an article identifying the massive buyer of credit default swap protection. The article gave him a nickname, the London Whale. The term was meant to be derisive, a massive, slow-moving creature leaving a visible wake in the water. Within hours, hedge funds across the globe had read the article and recognized the implications. Someone at JPMorgan had taken an enormous position and was clearly desperate to sell it. They had found prey. A hedge fund manager named Boaz Weinstein, who runs Sabre Capital, read the Bloomberg article and did the math. He realized the London Whale was trapped. The position was so large that the whale couldn't exit without moving the market against itself. Weinstein called other hedge funds. They formed an informal alliance. They began to systematically sell into the whale's bids, pushing the price down, forcing the whale to either accept losses or buy more at increasingly terrible prices. It was a coordinated attack, and it was brilliant. The hunter had found his prey, and now he was circling. On April 13, 2012, JPMorgan held an earnings call with investors and analysts. Jamie Dimon was on the line. Questions came in about the London Whale story. Analysts asked directly, "Is your bank exposed to a large credit derivatives position?" Dimon, speaking with the confidence of a man who had never been wrong about his bank's strength, dismissed the reports. "This plays in the press," he said, "and there's a lot of volatility." Then came the phrase that would haunt him: "All of these things will work themselves out, and we'll go from, what I call a tempest in a teapot to nothing. A tempest in a teapot." In one casual metaphor, Dimon had characterized a $157 billion position that was actively bleeding money as a trivial matter. The press quoted the line, "Market participants saved it." Investors noted it. The CEO of the largest bank in America had just told them there was nothing to worry about. 4 days later, they would learn he had lied. The weekend after the earnings call was brutal for the trading desk. Iksil and his team spent Saturday and Sunday re-examining their position. The market was moving against them in ways they hadn't anticipated. The hedge fund attack was working. The price of the index was falling, and as it fell, the value of the whale's insurance position was collapsing. Monday morning came, and the traders returned to their screens. The losses were accelerating. What had been a manageable position in January had become a vice that was tightening daily. Iksil sat at his desk and made a calculation. He estimated the losses at around $2 billion. He called his management. He told them it was time to sell. It was time to exit the position and accept the loss. His managers agreed. Now came the hardest part, actually selling. The market knew the whale was desperate to sell. Buying bids were nowhere to be found. The traders tried to offload chunks of the position, but every time they put size on the market, the price moved further against them. It was like trying to leave a sinking ship when everyone else was already in the water. By May 10, 2012, after weeks of trying to exit, JPMorgan realized the damage was worse than they had initially calculated. They called an emergency earnings conference call with investors. Dimon came on the line. The tone was completely different from April 13th. The CEO admitted the losses. He admitted they were larger than he had previously disclosed. He admitted the tempest in a teapot had become a flood. The bank took a charge of $2 billion for the trading loss. Markets reacted with shock. The King of Wall Street had been humbled. The fortress balance sheet had a crack, but the crack was deeper than anyone realized. As JPMorgan's traders continued to unwind the position over the following weeks, they discovered that the losses weren't $2 billion. They were $3 billion. Then they were $4 billion. Then they climbed past $5 billion. Then they climbed past $5 billion. By the time the full position had been liquidated, the loss had reached $6.2 billion. This was not a rounding error or a minor unexpected swing. This was nearly $6.5 billion in shareholder wealth evaporated. It was more than the entire annual GDP of Montenegro. It was larger than the market capitalization of multiple Fortune 500 companies. And it had happened in a division that was explicitly designed to protect the bank from losses. The irony was almost too cruel to contemplate. The fire extinguisher had become the arsonist. The autopsy that JPMorgan conducted afterward revealed the full scope of the disaster. The bank published a 129-page report that dissected every decision, every oversight, every moment where controls could have worked but didn't. The report examined the faulty Excel spreadsheet in granular detail. There was the analyst in London who had made the mathematical error. There was the fact that no one reviewed his work before the model was deployed. There was the fact that the risk calculation was displaying results that should have been impossible, yet no one questioned the validity of the metric. The report documented how traders had been marking their positions to market prices that didn't actually exist. They were reporting profits based on theoretical valuations instead of actual bids. In one recorded call, a trader said, "I think the position is dead. I don't know where we can exit." Yet internally, they were still reporting gains. The disconnect between reality and the numbers being reported was so vast that it's almost incomprehensible how it went undetected for 3 months. The Excel error itself became the symbol of the entire catastrophe. A senior analyst in the Chief Investment Office had been tasked with updating the value at risk model that the office used to measure daily risk. The previous model was considered outdated. Instead of implementing an entirely new system, instead of having multiple people validate the logic, the analyst simply created a spreadsheet in Excel. He copied data from one set of formulas into another. In one cell, he calculated the average of values. In another cell, he created a new formula. But the formula in the new model divided by the sum of the values instead of the average. The error was subtle enough that it wouldn't be caught with a casual glance, but mathematically it meant the risk calculation was off by a factor of approximately 2. When the model should have reported extreme risk, it reported moderate risk. When alarm bells should have rung, the system stayed silent. The spreadsheet was used to justify keeping the position open and even adding to it. If the analyst had simply divided by the average instead of the sum, the numbers would have screamed for reduction. Instead, the numbers whispered approval. The human element was even more damning than the Excel error. In recorded phone conversations, the traders and their managers discussed the position's precarious nature. One manager said, "We have to exaggerate the prices to make the positions look better." Another trader, Javier Martin Artiol, who reported directly to Iksil, was recorded joking with colleagues about the difficulty of exiting the position. "There is no liquidity," Martin Artiol said. "We are trapped." Yet these conversations were happening while the bank was publicly assuring investors that everything was fine. The gap between what was being said in the London office and what was being communicated to shareholders was a chasm. This wasn't incompetence. This was knowingly misrepresenting the health of the trading operation. The tragedy of Bruno Iksil is that he repeatedly warned his superiors that the position was becoming dangerous. He was a good soldier. He followed orders. But when those orders pushed him to the edge of a cliff, he warned about the drop. His management chose to ignore the warnings. The hedge fund attack orchestrated by Boaz Weinstein was the final trigger. But the position had been doomed for weeks. Once you've sold that much insurance, once you've bet that much on corporate stability, once you've created a position so large that you've become the marginal buyer in a multi-billion-dollar market, there is no graceful exit. There's only bankruptcy or a loss so large that it rewrites your company's financial statements. JPMorgan chose the latter. By mid-May, the position was essentially closed out. The bank had sold virtually all of the $157 billion notional exposure. The losses were crystallized. They amounted to $6.2 billion. The following month, Jamie Dimon appeared before the Senate Banking Committee. He sat alone at the witness table, no buffers, no advisors next to him. Senator Carl Levin, the committee's chairman, went through the timeline of failures methodically. How did the risk calculation get cut in half? How did traders mark positions at prices that didn't exist? How did a division designed to hedge risk end up taking the largest risk? Dimon, stripped of his usual armor of confidence, gave answers that came close to an admission of guilt. "We were sloppy. We were stupid," he said. "It was a terrible mistake." The king of Wall Street was bleeding. The market watched. The headlines burned. JPMorgan's stock fell sharply. The reputation that had been so carefully cultivated over decades took a blow that would take years to repair. The consequences rippled outward. The chief investment office's mandate was restructured. Ina Drew, the woman who ran the division, was allowed to retire and initially kept millions in stock, though she would later voluntarily claw back some of her compensation. The arrangement was far gentler than what happened to the traders at the bottom of the hierarchy. Bruno Iksil was suspended and eventually settled with regulators. Javier Martinatau faced criminal charges. Boaz Weinstein, the hedge fund manager who had orchestrated the attack, walked away with a massive profit. His fund had made over $700 million by betting against the whale. The irony of that number, $700 million in gains for a hedge fund manager, $6.2 billion in losses for a bank, encapsulates the entire story. The sophisticated player who saw the trap before it snapped made a fortune. The bank that claimed to have the best controls in the industry lost almost 7 times as much. JPMorgan paid $920 million in fines to the Securities and Exchange Commission, the Commodity Futures Trading Commission, and the Office of the Controller of the Currency. It was among the largest penalties ever levied on a financial institution, yet it was less than 15% of the total loss. The shareholders absorbed the rest. The executives who made the decisions that led to the disaster largely escaped with their reputations intact and their bank still solvent. JPMorgan, despite the loss, despite the scandal, remained the largest and most important bank in America. It was too big to fail, and everyone knew it. That knowledge, unfortunately, is a kind of permission. It's an assurance that even if you gamble with billions and lose, you'll survive. Other banks learned that lesson. The financial system learned it. The incentive structure remained broken. The real crime was not that the London whale trading loss happened. The real crime was that it happened in the division that was supposed to prevent such losses from happening. The chief investment office was the safety mechanism. It was the parachute. It was the backup plan for when the market turned against you. Instead of being conservative and hedging, it had become aggressive and speculative. The division that should have been warning the bank to reduce risk became the division that was actively hiding risk and persuading management that everything was fine. The Excel spreadsheet error was not the cause of the disaster. It was a symptom of a culture where checking your work, questioning numbers, and challenging authority had been replaced by speed, profit-seeking, and institutional inertia. The formula was wrong, but no one cared because the wrong formula made it look like things were going great. Boaz Weinstein, the hunter who had engineered the attack, understood something that JPMorgan's leadership had forgotten. In derivatives markets, there is always an attacker waiting for someone to take a position too large to defend. There is always a Weinstein watching for a whale. When you sit in a trade that's so massive that you're the only buyer in certain segments of the market, you're no longer a trader, you're a target. The mathematics work against you, the liquidity dries up, the predators circle. JPMorgan thought it was hedging. Weinstein knew it was dying. He bet accordingly, and he was right. The lesson of the London whale is not that trading is dangerous, though it is. The lesson is that when you design a system where the purpose and the incentives diverge, the incentives always win. The chief investment office was supposed to hedge risk, but it was measured on profitability. It was rewarded for revenue generation. So it treated hedging as a tool to generate revenue rather than a tool to manage risk. The traders were supposed to protect the bank, but they were compensated based on positions and profits. So they built bigger positions and claimed bigger profits, even when the underlying risk was increasing exponentially. The managers were supposed to oversee and constrain, but they were promoted based on division performance. So they turned a blind eye to warning signs and encouraged risk-taking because risk-taking generates short-term profits. And the executives were supposed to maintain the fortress, but they were evaluated by investors based on quarterly earnings and shareholder value. So when a division claimed to be generating returns, they praised it rather than questioned it. The structural problem that created the London whale still exists today. The incentive misalignment is as bad now as it was in 2012. The only difference is that regulators added more rules, more oversight, and more penalties. But rules can be gamed, oversight can be evaded, and penalties when you're too big to fail are just a cost of doing business. JPMorgan eventually recovered. Its stock rose, its reputation healed. Jamie Dimon remained in power and continues to be celebrated as a brilliant strategist. The bank that lost $6.2 billion in a division designed to prevent losses is still considered the safest and most well-managed bank in America. The fact that this narrative persists despite what happened is perhaps the darkest lesson of all. The system protects itself because it has to. If JP Morgan was reckless, then the entire financial system is reckless. If its controls were inadequate, then everyone's controls are inadequate. So the market, the regulators, the investors, they all have an incentive to declare victory and move forward, to treat the London whale as an exception rather than a symptom of something deeper. The price of admitting otherwise is too high. The financial system is built on confidence. Lose confidence and the whole structure collapses. So Dimon will keep saying the controls are strong. JP Morgan will keep saying the incident was isolated. And somewhere in a trading office, another analyst will be updating another spreadsheet, checking his work maybe a little bit better than before, but working within a system where the incentives still push toward hiding risk rather than managing it. The whale didn't die in May 2012. It just learned to be more careful about hiding its size.